Laura Anthony, founding partner of Anthony P. LLC, a full-service corporate securities and business transactions law firm. Today is the first in a Lawcast series talking about recent amendments to part of NASDAQ's 20% rule. Effective September 26, 2018, NASDAQ amended Rule 5635D to provide greater flexibility and certainty for companies to determine when a shareholder vote is necessary to approve a transaction that would result in the issuance of 20% or more of the outstanding common stock, or 20% or more of the outstanding voting power in a PIPE or similar private fund placement financing transaction. The amendment did not change the remainder of Rule 5635, which requires shareholder approval for transactions such as issuances involving an acquisition of stock or assets of another company, a change of control, or equity compensation, all that could result in 20% or greater dilution. Generally, Rule 5635D requires NASDAQ-listed companies to obtain shareholder approval in private placement transactions involving the issuance of common stock or securities convertible into or exercisable for common stock at a price less than the greater of book or market value, which, together with sales by officers, directors, or substantial shareholders of the company, equals 20% or more of the common stock or 20% or more of the voting power outstanding before the issuance. Or 2, the sale, issuance, or potential issuance by the company of common stock or securities convertible into or exercisable for common stock equal to 20% or more of the common stock or 20% or more of the voting power outstanding before the issuance for less than the greater of book or market value of the stock. The amendment combines these two sections into one and amends the pricing test for triggering shareholder approval. The new pricing test amends the definition of market value solely for purposes of Rule 5635D to create a new minimum price, as I'm going to talk about. Prior to the amendment, Rule 5635D exempted from the shareholder approval requirement offerings priced at or above the greater of book or market value per share, with market value defined as the closing bid price. That is, the rule generally only required a vote if the dilution resulted from offerings that were priced at a discount to market value or book value. The rule amendment eliminates the book value test and revises the definition of market value to incorporate a 5-day average and to use the last closing price instead of the consolidating closing bid price. As a result, under the amended rule, a private offering involving the issuance of 20% or more of the common stock or 20% or more of the voting power outstanding before the issuance will not require shareholder approval if the offer price is greater than or equal to the lesser of 1, the last closing price immediately preceding the signing of a binding agreement, or 2, the average closing price of the common stock on NASDAQ for the 5 trading days immediately preceding the signing of the binding agreement. This is the minimum price. Shareholder approval will be required for private placements priced below the minimum price. I'm securities attorney Laura Anthony, founding partner of Anthony P. LLC and producer of Lawcast. Should you have any questions about today's topic, please visit securitieslawblog.com and lawcast.com or contact me directly. Inquiries of a technical nature are always encouraged.